It's one of the most unusual sights in modern finance. Markets are near record highs. AI stocks have turned into the center of the financial universe. Commentators sound euphoric, and Berkshire Hathaway, the company Warren Buffett built into one of the greatest investing empires in history, is sitting on a record cash pile. Not chasing the rally, not forcing money into expensive stocks, not trying to prove that it still understands the moment, just waiting. By the first quarter of 2026, Berkshire Hathaway's cash and short-term Treasury holdings had reached roughly $397 billion. That is not a typo. $397 billion. And the important part is not just the size of the number. It is what the number implies. Berkshire is one of the most patient capital allocators in history. It does not hold that much cash because it forgot how to invest. It holds cash when the available opportunities do not meet its standards. That does not mean Warren Buffett predicted a crash. It does not mean the market has to fall tomorrow. Valuations can stay expensive for years, but it does mean something. It means the institution built by the world's most famous long-term investor appears to be saying that today's prices do not offer many obvious bargains, and that may be the real warning Wall Street is ignoring. To understand why this cash pile matters, you need to understand one valuation measure that has followed Buffett around for decades: the Buffett Indicator. The calculation is simple. Take the total value of the US stock market and divide it by US gross domestic product. In plain English, it compares how expensive the stock market is relative to the size of the economy beneath it. When the ratio is low, stocks may be broadly cheap. When the ratio rises far above its long-term range, the market may be pricing in a level of optimism that becomes difficult to justify. Buffett once described this kind of market cap to GDP measure as probably the best single measure where valuations stand at any given moment. By May 2026, several valuation trackers placed the Buffett Indicator in the roughly 230% plus range. For context, it was far lower before both the dot-com crash and the 2008 financial crisis. Now, this is not a crash timer. It cannot tell you what the market will do next week, next month, or even next year. But it can tell you something important. Investors are paying historically high prices for ownership of American businesses. And while markets focused on AI optimism, record index levels, and momentum, Berkshire kept building liquidity. That is the first part of the signal. But there is an important counterpoint. Berkshire Hathaway is not a small hedge fund managing a few $billion. It is a massive conglomerate with hundreds of billions in deployable capital. At that size, even excellent investment opportunities may be too small to matter. Buffett has acknowledged this problem for years. The larger Berkshire becomes, the harder it is to find acquisitions or stock positions big enough to move the needle. So, the cash pile is not purely defensive. Part of it is scale. When you manage capital at Berkshire's size, patience is not just a personality trait. It is a structural necessity. And yet, even with that context, the size of the cash position is hard to ignore. Here is where the story gets more interesting. Berkshire was not simply sitting on idle cash and earning nothing. It was being paid to wait. During the near-zero rate years, cash was painful. Every dollar sitting in Treasury bills earned almost nothing, and inflation quietly ate away at purchasing power. But after interest rates rose, short-term Treasury bills became a serious source of income. Berkshire's own annual reporting shows that interest and other investment income surged in 2024. Driven largely by higher yields on US Treasury bills and short-term investments. In other words, waiting became profitable. That matters because Buffett's patience was no longer just philosophical, it was financial. Berkshire could hold liquidity, avoid overpaying for assets, and still earn billions in relatively low-risk income while it waited for a better opportunity. At the same time, Berkshire was reducing exposure to one of its greatest investments ever, Apple. At its peak, Berkshire held more than 900 million Apple shares. By late 2025, that position had been cut dramatically, though Apple remained one of Berkshire's largest holdings. That does not mean Apple became a bad company. Berkshire can sell for many reasons: taxes, concentration risk, portfolio management, or simply better use of capital elsewhere. But the move is still worth noticing. When one of the most patient investors in history starts reducing one of his biggest winners during a strong market, it raises a question. Was Berkshire seeing more value in liquidity than in adding more equity risk at those prices? Then came the leadership transition. At the 2025 Berkshire Hathaway annual meeting, Buffett surprised shareholders by saying the time had arrived for Greg Abel to become chief executive at year-end. Abel officially took over as CEO on January 1st, 2026, with Buffett remaining chairman. What Abel inherited was extraordinary: a giant operating business, a legendary investing culture, and the largest cash reserve Berkshire had ever reported. That timing matters. By early 2026, another valuation measure, the Shiller-Cape ratio, was hovering near 40, more than twice its long-run average, according to several valuation trackers. Again, Cape does not predict the exact timing of a downturn, but historically, very high Cape readings have often been associated with lower long-term forward returns. Buffett built his career exploiting the difference between price and value. And at the time Berkshire's leadership changed hands, that difference appeared to be working against buyers. The people dismissing Berkshire's caution should probably remember that Buffett has looked out of touch before. In the late 1990s, he refused to chase dot-com stocks. Critics called him too old, too slow, and too stuck in the past. Berkshire underperformed while internet stocks went vertical. Then the Nasdaq collapsed. In 2007, Berkshire's cash position also gave it flexibility as housing mania and credit risk built across the financial system. When the financial crisis hit, Buffett was able to move quickly, providing capital to companies such as Goldman Sachs and General Electric on unusually attractive terms. That is the recurring pattern. Buffett often looks boring during euphoria. He looks far more interesting when the market finally wants cash. This does not mean the current moment has to become another 2000 or another 2008, but it does explain why Berkshire's position gets attention. Cash is not exciting when everyone is making money. Cash becomes powerful when everyone else suddenly needs it. There are also signals outside Berkshire that made investors uncomfortable. First, market concentration. A small group of giant technology companies has carried a large share of index returns, and several estimates show the top 10 companies representing a historically large portion of the S&P 500's value. That does not automatically make the market fragile. Many of those companies are highly profitable, but it does mean the market's performance has become heavily dependent on a relatively small group of winners continuing to deliver. Second, speculation. Options trading has become a major part of the market's daily rhythm, especially short-dated contracts that expire in days or even hours. That kind of activity can make markets feel more like a casino than a long-term ownership system. Third, AI valuations. Some AI-linked companies are priced for years of near-perfect execution. Maybe those expectations will be met, but history shows that even transformative technologies can disappoint investors when the price paid is too high. Fourth, debt. Companies that borrowed cheaply during the near-zero rate era have been forced to refinance in a world where money costs more. Higher rates do not break every business, but they do change the math. None of these signs individually guarantees a downturn. Together, they suggest a market where a lot has to go right, and Berkshire's response has been simple: do not force it. That is what makes the Abel era so fascinating. The cash pile is not just a warning signal, it is also ammunition. $397 billion does not sit in cash forever. Eventually, if prices fall, if fear replaces greed, or if a once-in-a-decade acquisition opportunity appears, Berkshire can move. When Buffett deployed capital during the financial crisis, Berkshire's deals came with preferred dividends, warrants, and protections that ordinary investors could never access. The company was able to negotiate from a position of strength because it had liquidity when others were desperate for it. That is the hidden power of the cash pile. It is not just protection from downside, it is optionality. It gives Berkshire the ability to wait, then act decisively when prices finally make sense. And now, that optionality belongs to Greg Abel. Maybe markets keep climbing. Maybe AI profits justify today's valuations. Maybe the economy grows into the price of the market over time. That is possible. But the signal remains. Berkshire Hathaway is holding the largest cash pile in its history, while valuation indicators sit near historic extremes. Market concentration remains elevated, and investors are still paying premium prices for future growth. Warren Buffett did not need to go on television and warn investors about a crash. He did something quieter. He let Berkshire's balance sheet speak. And right now, that balance sheet says one thing very clearly. Patience is still a position. And when the most patient investor in modern history leaves nearly $400 billion waiting on the sidelines, Wall Street should probably pay attention.